Hi, everyone. Thank you for joining us for Horse Sense Street Smart Investing, the podcast. I'm Ron Corning here with the Hodges brothers of Hodges Capital Management, and we're talking meme stocks. And guys, I mean, I don't profess to know all the ins and outs of your business, but I'm going to venture a guess. At no point along the way during the meme stock frenzy were you thinking it might be time to do a meme stock mutual fund for our clients. That never happened, did it, Craig?
Not in the cards. I don't believe so. Nope. We were as confused as everyone else, I think.
And I think that's an important point to make, that was an anomalous thing that was born out of a social media community like Reddit, which got involved at looking at these companies that were diminished in value. How can we get behind them and boost the stock price? Let me ask you this about it. Were you surprised it had the impact that it did on the price of the stock for companies like GameStop and AMC?
Yeah, it kind of came out of nowhere. But when you look at what happened, somebody was smart enough to figure out that there were some vulnerable stocks that were heavily shorted, that were probably illegally shorted. And they realized that if they could get enough people, enough support, that they could cause a short squeeze. And I'd never seen anything like it. I don't think anybody has ever seen anything like it. So it was a kind of a new phenomenon, and it actually put some established hedge funds out of business, completely out of business.
And it definitely shed a light on maybe where the system has allowed for some stocks to be manipulated, really, I think was the takeaway from that. And I said it was anomalous, which means it was a rarity. But I don't know. Can we rule out that it is over? Could it happen again, Clark?
Oh, I guess you could say it could happen again. I mean, it's basically because of the internet it happened. So there could be some new app or some new thing come out that could create that perfect storm again, if you will. The problem I have with it is the customers who lost so much and were not educated on what they were doing. So in our business, you really have some mandatory rules of fiduciary responsibility, and the people that are buying the meme stocks, they're doing it probably online, and there's no service with that account, and they're buying it on margin. And I did read a lot of stories of people just losing a ton of money and really bad situations for probably younger people. And it's just a hard lesson to learn, but a lot of people did probably learn that lesson the hard way.
Well, that's an absolute matter of fact that people lost money. People made money who got in on the front end and got out at the right time. But for some, it was just on paper, because the higher it went, the higher they thought it would go.
But the people who made money are going to think, golly, this is easy. Golly, I'm going to day trade or weekly trade my account from now on. And by this time, they've regretted that, because you can't do that.
And I'm wondering, Craig, you've always, I know, as an investor as a money manager who looks long-term for your clients and who sees the value long-term in companies with strong fundamentals, and you pivot and make changes according to how those industries might change based on economic factors and all of that. It's very complicated, and it's what you do for a living. When that sort of thing happens and you're faced with questions from people like, well, I had a friend who got into GameStop and doubled his money. Why didn't we do that with some of the money in my account? You say what to that?
I say define who you are. Are you an investor? Are you looking for companies that are going to make you money just on their internal business, their rate of return? Or are you playing a game where your making money depends on somebody buying the stock from you at a higher price? Mm-hmm. What are you doing? In investing, it is very important to define what you are and what your goals are. If your goals are to make money quick and to find the hottest stock, good luck on that. That's basically gambling.
I was going to say, that sounds like a trip to Vegas.
Yeah, that's yeah. But there's nothing wrong with doing that, but know what you are. But at the heart of what we're trying to do, we're investors. We want to put our money in companies that while we sleep, and if nothing else changes, the internal rate of return of the business will grow and we'll make money. That's the problem with things like Bitcoin or even gold, or you need somebody to think it's more valuable than it is in order for you to make money. Mm-hmm. And if you own a company that's earning 20% on their money, you don't.
And creating new products and new services and seeing their bottom line increase, right?
That's right.
And their costs staying down. Again, those all speak to the fundamentals of a company. I wonder, where does this take us? Because we know that day trading has been born out of the accessibility and the ease of being able to have an account, be it Robinhood or Webull or any of those. That is here to stay. But we are seeing now that as people aren't home all day, stimulus checks aren't coming in, they're not dealing with, if they remained employed during the pandemic, we saw people with more cash flow or more discretionary income that they were putting into day trading. The numbers bear it out that sort of tapered off. So was that just a pandemic era anomaly, or will we see in the future sort of ebbs and flows of people getting into day trading?
Well, I think you'll see markets again where that works. Like Craig said earlier, it's about what kind of market are we in, and you'll get those fluffy markets where high-priced stocks, high-multiple traded stocks are doing well again. And so in that environment is usually when those kinds of things happen.
Mm-hmm. But again, Craig, that's not a play for longevity and wealth over the long term. It just isn't.
It's speculating. It's speculating. And you need, for speculation to work, especially on the extremes, you need a good stock market. I mean, that's just, those things don't happen in a severe bear market.
So the majority of all stocks needs to be moving up, right? To be able to move that money around and think you're making money.
Yeah. And I think the lesson of this market is for 4 or 5 years, but probably because of the excess liquidity that was out there for several reasons, it created a dynamic that stocks would go up and up and up, and stocks traded at, 10 times sales, 100 times earnings. It didn't matter. Everything works in that environment. But when you get into a tougher environment, it really it's a whole different deal. And you've seen a lot of the stocks that were so popular and so owned down 60, 70, 80% just this year.
Well, we also can't forget that run up during the pandemic was born out of essentially a crash in March of 2020, a total reaction to closing down the economy, and then it bounced back.
I think when you just have the topic of meme stocks, the thing that I hearken back to and think about is the individual investor who's doing that is probably a young person. Investing is such a good thing for families, for people in the long term. What did that young person who had a horrible situation happen to him because he thought meme stocks was the way to go? Is he going to give up investing, or is he going to graduate someday to hiring a money manager and letting someone else do it, and he can do his job? And I think that's what you need to think about, is the human impact of those meme stocks is pretty ugly.
So yeah, I get what you're saying, that it could have had such an impact on people who lost money at a young age that they've just decided the stock market, the stock market's a bad place to be. And it really isn't. You just have to know how to go about it the right way. Appreciate the conversation as always. And thank you for joining us for Horse Sense Street Smart Investing, the podcast. I'm Ron Corning. We'll see you next time. To learn more about the topics we covered in this episode, visit hodgescapital.com. Continue the conversation on our Facebook page, and listen and download this episode and previous episodes on Apple Podcasts and on all other podcast platforms.
Hodges Capital Management Incorporated, HCM, is an investment advisory firm registered with the Securities and Exchange Commission, SEC, is a wholly owned subsidiary of Hodges Capital Holdings, and serves as investment advisor to the Hodges Funds. HCM is affiliated with First Dallas Securities Incorporated, a broker-dealer and investment advisor registered with the SEC. This discussion is not intended to be a forecast of future events and should not be considered a recommendation to buy or sell any security. Past performance is not indicative of future results. Investing involves risk. Principal loss is possible. Investing in smaller companies involves additional risk, such as limited liquidity and greater volatility. No current or prospective client should assume that information referenced in this communication is a recommendation to buy or sell any security, or is a substitute for personalized investment advice from your individual advisor. HCM does not provide tax or legal advice. Consult your tax or legal advisor for any related questions. All information referenced herein is from sources believed to be reliable and is provided as general market commentary and does not constitute investment advice. This material was created for informational purposes only, and the opinions expressed are solely those of HCM. HCM shall not in any way be liable for claims and makes no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information. The data and information are provided as of the date referenced and are subject to change without notice.